Hey equity mates, if you're finding it hard to keep up with financial news and everything that's going on in the world, then jump online and sign up to our weekly Thought Starters email. One email a week, no spam. We hate spam. And you will get all the investing news you need to know and some interesting articles to get you thinking. It's free, just like the podcast, and it's just more content for you to enjoy.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome to another episode of Equity Mates, a podcast where we will help you learn to invest in 20 minutes or less. We break down the world of investing from beginning to dividend so that you can hopefully make some returns. My name's Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going, bro?
I'm very good, Bryce. How are you?
Good. You on holidays? Or are you still at work?
Well, this will be going out. You're testing my maths here.
Sure. You're on holidays.
Well, yeah, I'm definitely on holidays. I think last episode was a couple of days before Christmas, so this one we might be celebrating New Year's together.
Oh, true.
Yeah, this will be out on the 30th of December, so we'll be down the coast.
Mate, how exciting!
Yeah,
how
very exciting. We'll make everyone who's with us listen to this episode.
Yeah, that's actually not bad. All right, New Year's treat.
Yeah, what a way to bring it in.
What a way. So for all of the those listeners who have just joined the show, welcome. To recap, Ren and I have taken a Christmas break, and we have been deep diving into 5 Australian companies that we've randomly selected from the Australian Stock Exchange, purely by typing in the first 2 letters of the ticker, and whatever came up, we decided to deep dive in. So the first one we did was Baby Bunting, retail company. Second was Latin Resources, an exploration company in minerals. And now, Ren, we've got another industry, one that we haven't really discussed on the show much, to be honest, and that is REIT.
Yes.
Real Estate Investment Trusts, REIT. And today we are going to be discussing a company called GPT Group. Its ASX ticker is GPT. So if you want to follow along as we go through it, chuck it in Google and take a look. So real estate investment trusts, Ren, what are we talking about here?
Yeah, so they are essentially companies that own real estate assets. So houses, office buildings, you know what real estate
Commercial.
is. Industrial. No, yeah. We don't need to explain real estate. People get that.
Yeah.
But yeah, the company owns and manages the real estate. So GPT Group is a big one. They're one of the bigger ones. They're actually an ASX 50 company. They're quite large. They own a $22.7 billion portfolio of offices, logistics centers, warehouses, stuff like that, business parks and shopping centers.
Massive.
I wonder if that $22.7 billion valuation has gone down with the recent property market fall.
It's a good point, and we'll look at that a bit later on in the finance because, we'll look at that a bit later. But good point. Has their share price suffered?
Well, no. So when I first started looking at this company in late November, its share price was $5.36.
Yeah.
As of our recording date on the 11th of December, the share price is actually up $5.47. And that gives it a market cap of $9.8 billion.
So I guess with that, Rents, you look at their portfolio and, in the media at the moment, we're looking at a house price correction, potentially, a fall in retail, in residential housing, whereas the portfolio of GPT Group is primarily made up of real estate assets that aren't residential housing. So they've got shopping centres and they've got a huge amount of office space. As you said, they've got business parks, and they also have a couple of fund management aspects to the business. So whilst the value of residential housing in Australia might be taking a turn, the income and demand for these other real estate assets might not be necessarily affected quite as much as we're seeing in the real estate space. So this is one reason that we might be seeing a share price at the moment that's being supported. And as you said, $9.8 billion, they're a massive company. So pretty interesting one.
Yeah, definitely. Now, keen listeners may have picked up that the company manages a $22.7 billion portfolio of real estate, and it's valued at $9.8 billion market cap. The obvious question might be, are you paying $9.8 billion for $22 billion worth of property? The answer will be later in this episode.
Oh, what a tease.
Yeah.
That's a very good question.
So let's rip through a little bit more on the company if you've got anything, and then we'll go into the industry and competition. I mean, we've already sort of spoken about the housing market, the residential housing market, but we'll touch on that. Then we'll get into the financials, and then we'll finish with the valuation. And then I have one question for you to finish it all off.
Oh, it's truth.
Any other major headings you want to touch on?
No, that sounds good. I'm happy with that.
All right. Well, the first thing that struck me about the company when I was looking at the share price history was in December 2007, it was worth over $18. Then by March 2009, it was trading at $1.35, and now it's in the mid $5 range. It's had a pretty crazy journey. I'm not actually sure if there were stock splits between 07 and 09, but I think obviously real estate didn't do too well there internationally, so I assume that has something to do with it. There was probably a lot of fear.
Yeah, I'm just trying to find if there was any stock splits, but I can't see anything. So, I mean, at that time, when was it? 2008, 2009, did you say?
Yeah, December 2007, it was trading at over $18. And then by March 2009, it was $1.35.
Well, I guess, when you're in an industry that their revenue would be reliant on, income from renters in their retail space and business parks and that sort of stuff. And in a time of a recession or subdued economic activity, they might not have been able to charge anywhere near as much rent as they were when things were booming in 07. I guess that could be one reason, but that's a very significant drop from $18 down to $1.
Yeah,
so,
you'd be
geez.
stealing.
Yeah.
I mean, look, to be honest, for my mind, the company is pretty straightforward in terms of its operations. It manages real estate. In some instances, develops real estate. In most instances, purchases already developed real estate. So, lend lease, a construction company, whoever will build a office, they'll then sell it to this company, and then this company will manage it, is sort of the general way that it works. I don't know. Do you have anything more on the company specifically?
No, as you said, Ren, very straightforward. I don't honestly know a lot about the real estate investment trust space. So I'm looking at some of their, the occupancy rates of their retail and office spaces, and they seem quite high, 99.6% occupancy rate for their retail properties and 95% in their office space. But to be honest, I don't really know what to compare that to. To me, it seems solid, but tough to know. So I think we move on.
I guess what we would say there is, if we were actually looking to invest in this company rather than just doing it as an exercise for the podcast, you would look at things like its occupancy rates, the length of time it had left on its leases, the average lease length, all that stuff, and you would compare it to the industry, and then you would make an assessment of how strong its position is, if it's riskier, if there seems to be any red flags there.
Yeah.
If it seems to be broadly in line with industry average, you would probably say it's no more risky than any other real estate investment trust. If for whatever reason, its leases were being broken, far more regularly than other real estate investment trusts, you might say there might be an issue there that you need to look further into.
Absolutely. All right. So next, what are we on?
So I guess we've really covered off the industry and competition.
Yeah.
Property headwinds, a big one, but that's primarily residential, but I'm sure it will spill over into other real estate assets. And then also the risk of higher interest rates, what that will mean for property valuations and stuff like that. I don't know. Do you have anything else major?
No, I think we've covered pretty much most of what I've got in my notes. So let's move on to anything you want to discuss before finance.
No, let's get into it.
Easy. So this was an interesting one. Well, I enjoyed looking at this because, since we know that we've been in a residential property boom since 2008, 2009. And interestingly, if you look at the rental income for that period of time from, say, 2008 to 2017, it's been reasonably consistent at about $500 million a year. However, if you look at their net profit after tax for that period of time, it has gone up a considerable amount from, say, 2008 through to, well, actually from 10 through to 17. So there's something in there that is giving them a nice boost. Do you have anything to add to that, Ren, before we go a bit further?
Yeah. So look, it's an interesting one, and it's a big thing with all real estate investment trusts that you have to be really careful about when you're valuing them and when you're looking at them, because as a business, you have to report your income or your net profit affects the way that REITs report. If you look at this company's income statement, it has 1.27 billion in net profit after tax. And as you pointed out, about $500 million of that, so I think it's 554 million, is funds from operations. So that's the income. So that's the other 718 million is from valuation increases. So the increase in the value of the properties that they're holding. Now, as an investor, that's great that the valuations have increased, but if you just care about the cash that the business is generating, you just want to look at the funds from operations. And so in all real estate investment trusts, you'll see this metric, FFO, funds from operation, and that's the cash that has been generated from the business operations. So that's an important metric to look at. And then, if you say off the 22 or $21.5 billion in property that they own, they've generated about $500 million in funds from operations. That means they're getting about a 2.5% return on their assets. It's important that's something that you'll always come across, and that's why they might be spitting out the same amount of cash every year, but their net profit number is changing massively. It's because their net profit number is exposed to changes in the property valuations, changes in the property market.
That's interesting. Because if your property values are falling but your income is still consistent, and I think this is where the value of long-term leases comes into play as well, because it looks like they really haven't. I mean, the rental income has gone up slightly for over the last 10 years or so, but like nothing significant. Doesn't look like they've been increasing rent anywhere near in line with the increase in the value of their property. And I guess that's because a lot of their income would be a lot of their properties would be in longer term leases, lease agreements. But that's interesting to know. I didn't know it was that specific, and I didn't know that was the way that they had to report. So I guess we could see if it goes in line with residential property at the moment, Ren, that we could start seeing a significant decline in their profit reporting.
Well, yeah, and you see, this is the interesting thing when you really think more and more about it, because what might happen is their net profit number might go down massively if the valuations plummet, but at the same time, their return on assets would go up because the value of their assets is a lot lower, but their income is still the same. But realistically, nothing has materially changed in their business. They still own the same properties that they paid the same amount for. You know, the mortgages, the interest they're paying to the bank for those properties hasn't changed, likely won't have materially changed. Then the income that they're getting, like the funds from operation that they're getting, if they're long-term leases, won't have materially changed. So you might see, as you said, massive fluctuations in things like return on assets and net profit and net tangible assets. But at the end of the day, like, they're a business that just owns these properties, rents them out, and gets income from them. And that isn't massively fluctuating from year to year.
No.
You've always got to be a little bit careful when you're looking at these REITs income statement and balance sheet.
What do you think's more important when you're looking at that? Are you looking, I mean, as an investor, you'd be wanting to see, it'd be obviously good to see both, but you can't, as you said, if you're not going to liquidate any of your property and increase in the property value, and as an investor, you're not really actually going to get much return on that. It's the rental income that you're going to be making your money from.
Yeah. Now, this is what I thought as well. Like that makes logical sense. And the way that we think about, investing is we think about part ownership of a company. Each share entitles you to that portion of the company's cash flow that it spits out as a business, and you want to invest in businesses that can then reinvest that cash flow for high rates of return over a long period of time. And that's how you, as a part owner in that business, make more money. So that makes sense. And for us, it makes sense to focus on the cash that a business is spitting out. But when I was looking at how these companies are valued by the market, at least, it looks like they're valued more by their assets. So to run you through the balance sheet, this company, GPT, has 13 billion in assets, and then you add on its funds management business to get you to the whatever we said before, 22.7 billion in property managed, but it owns 13 billion in assets. It has 3.9 billion in liabilities, so that's things like debt and stuff like that. Which meant that its net assets, at least the last time it reported, was 9.1 billion. And that, if we look at the price to book value, so the share price compared to the book value of the company, is 1.01, at least when I last looked at this in November. So looking at other REITs, it appears generally that's the ballpark. These REITs are valued at their price to book ratio. And I guess the logic behind that, when you think about it, is that if this company was going to be liquidated and it sold all of its assets, this is the money that would be returned to the shareholders. So that's how that's how you value it. So although it does make sense in terms of valuing other companies to value them by the cash flow, it seems that the way that the market values these REITs is based on the value of the assets it holds, which in the case of REITs is the value of the real estate that it holds.
There you go.
Yeah.
But yeah, so it's not a massive income generate. You wouldn't go into it expecting. Yeah, it's an interesting one. What do you want out of it? You want both, really. You want them to continue to slowly increase their money that they're getting from rent, but equally as you want, if that's the way that the market's going to value the company, you want your share price to go up. You're obviously going to want the properties to go up as well. Yeah.
It's tough, but I guess, and this is just me spitballing here, but I guess the logic is if you're investing in a REIT, you're investing in it because you want to be exposed to the property market. If you want to be just invested in a company that gets good return on assets and makes money by producing income, you can probably get better companies out there.
Yeah, there's other ways to do it.
Given that, the return on assets for GPT was like 2 and a bit %. So
that makes sense.
That may be it, may not be. If people know more about REITs, hit us up, because I haven't done a lot of research into them before we did this GPT group analysis.
Yeah. Nice.
All right. So final question from me, unless you have anything else.
Oh, no, pretty well covered there. I was going to go into a bit about the debt for these sorts of companies as well, but we've discussed that in a bit of detail for some other companies that are a bit similar to the way that they use debt. So all good. Hit me with your question, Ren.
All right. So would you rather invest in a REIT, a real estate investment trust, or a property ETF, and why?
Or a property ETF.
Yeah.
Are there such things?
Yeah, so there's a BlackRock iShares Australian listed property index fund, or like a Vanguard Australian Property Securities Index ETF. Yeah, there's a bunch of global real estate ETFs. So if you wanted to get exposure to the property market, where would you go?
Well, if I'm just thinking about this, if you've got a Vanguard or a BlackRock property ETF, it's just going to be following a whole bunch of REITs, right? Is my thinking.
Yeah, I'm pretty sure that's right.
So then it comes down to either getting a broad exposure to a number of different REITs at a low expense, or then going in and looking at individual REITs and I guess honing in on specifics in terms of the asset, it being residential or whatever. That's a tough one. I would say in the climate that we have just had, I would have gone a REIT, but if I had to choose now, I'd go an ETF.
Interesting. Okay. Yeah, look, I don't think there's a right answer to that. I think where you were going was sort of where I would go as well, that it seems like a lot of the property ETFs out there are indexed, so they take a variety of property, REITs or funds or whatever, and sort of index those returns, so you get a more broad exposure to the property market, whereas REITs, can be a little bit more specific.
What's your answer?
Oh, I think I would probably be interested in REITs, but I think really both of the returns come from how the property market goes.
Yeah.
But yeah, I'm sure that if people are interested in investing in property, that question would come up.
I wonder if you can short a REIT. You definitely can. I mean, if you could get an inverse ETF for property, something I'm going to look into.
Yeah, you probably could. Shorting a specific REIT would be like shorting a company.
Any stock,
There would be options. If you're big enough, you could probably borrow the shares and sell them and then buy them later. I've just Googled inverse real estate ETFs, and yeah, there's the first article is top 3 inverse real estate ETFs.
Okay.
So there you go. There's a lot of options.
Nice, Ren. Well, so far we've learnt about the retail industry through baby bunting. We've looked at lithium and cobalt exploration through Latin Resources, and now we've had a bit of a look at the real estate investment trusts, REITs, that you often hear about. So we've been quite diverse, and next week we've got DOR, which is, I can't remember what it was.
An oil and gas company.
Oil and gas. Okay.
Yeah.
So back in.
But I found, we won't spoil the next company, but there was something very interesting about the way that this company is structured.
Okay. Detective Ren.
Yeah.
He's got his magnifying glass out, digging deep. All right. Well, unless you have anything else to add, Ren, we'll leave it there. Do you have a valuation?
For this company?
Yes.
Well, so if we're using price to book, it was about a 1.01 ratio now. So it seems like the market broadly in line with what I would use.
Yeah, nice. Fair enough. Well, we'll have a good New Year's. We'll be together. I hope everyone else does. Again, quick thanks to everyone for an awesome 2018, and we can't wait for 2019. Stay tuned. We've got 2 more companies to come before we come back in mid-January.
Can't wait.
Equity Mates and the people appearing in this program may have positions in the companies mentioned. This is general advice only. Please speak to a financial professional to understand how it may pertain to your individual situation.
So, Ren, we've definitely discussed Instagram way too much, so I'm going to spring my housemate right now and ask him 3 reasons why he loves Equity Mate's Instagram. Rohan.
It's topical, it's funny, and I've learned a lot about investing and a little bit about myself.
There you are, testimonial. Get around it.